How does inflation targeting achieve price stability? Imagine a world where prices stay steady and you don't have to worry about your money losing value overnight. That's the goal of inflation targeting, a strategy many central banks use today. But how does it actually work to keep prices stable? Let's break it down. Inflation targeting starts with a clear goal. The central bank sets a specific inflation rate to aim for, usually around 2%. This number is announced publicly so everyone knows what the central bank is trying to achieve. It acts like a target on a dartboard, helping guide decisions and expectations. When people, businesses, and investors know the goal, they can plan better because they trust prices will stay relatively stable. The central bank then watches how prices are changing and makes forecasts about future inflation. If the forecast shows inflation will go above the target, the bank can raise interest rates. Higher interest rates make borrowing more expensive, which slows down spending and investment. This cooling effect helps bring inflation back down toward the target. On the other hand, if inflation is expected to fall below the goal, the bank can lower interest rates. Cheaper borrowing encourages people to spend and invest more, pushing inflation back up. This process usually looks at a time frame of 2 to 3 years, not just the next few months. It gives the central bank some flexibility to handle short-term shocks, like sudden economic changes, without losing sight of the overall goal. This approach helps prevent overreacting to temporary issues and keeps expectations anchored on stable prices. Inflation targeting became popular after the high and unpredictable inflation of the 1970s and 1980s. Central banks wanted a system that was transparent and accountable, so they could better control inflation and reduce uncertainty. By focusing mainly on keeping inflation low and stable, they avoided the problem of trying to do too many things at once, like boosting employment and controlling prices at the same time. Today, many central banks still follow inflation targeting because it provides a straightforward rule for managing the economy. While they sometimes consider other goals like employment or financial stability, price stability remains the main focus. Stable prices support economic growth because they protect the value of money and make it easier for everyone to plan their finances. In the end, inflation targeting works by setting a clear goal, using interest rates to guide the economy, and being flexible enough to respond to changes. This combination helps keep inflation low, predictable, and under control over time. It's a simple idea that has helped many countries improve their monetary policies and keep their economies steady since it was introduced.